The interest-only trap. Let's have a look. Good afternoon, everyone. Florian Heise here, and welcome to another episode of Heise Says. I have my afternoon stein of coffee, and frankly, I want to look at this article about the interest-only traps because I've been doing bookkeeping all day, and I'm about ready to explode. Explode. Lots of fun. So let's have a look at this, because interest-only loans, they're resetting, are hurting borrowers. Now, I've spoken about this previously, and I'll bring up this video here, where the interest-only period was coming to an end on a lot of these loans. And there was some speculation that the flood of these properties unable to get financing again for interest-only period may start to appear on the market because people are forced to sell simply because they cannot afford to meet the repayments, because there's some drastic increases for some people that have been paying interest only for a long time. Now, one thing I'd like to draw everyone's attention to is the speech that Bob Katter gave in the cash ban debate to the empty House of Parliament, and I will link to that here. I'll just put a timestamp here for Bob Katter, where he was sharing the story about a farmer who met his interest payments, kept up with everything, and then the bank simply changed their mind, saying, well, yeah, we're not happy being, we don't think that your property is worth what it is, even though you've met all your repayments, you haven't defaulted at anything, we're just getting out of this sector, so we're selling you up. Okay? That's an interesting one to watch, an interesting insight, and it might wake up a lot of people to realize that the banks, well, they're not your friend, and it's a completely one-sided deal. They can change the conditions of your relationship with them on a whim. I've also spoken to other people, brokers in the industry, that had to come to the rescue of people because the banks just said, nope, this is after 9/11, nope, your sector's too scary, we're getting out of that one, you've got a month to pay off your mortgages, all your credit cards, everything. So they're not on your side, guys. So let's have a look. Interest-only loan reset hurting borrowers despite the rate cuts. I mean, that's even more scary. So when Laura Christopher bought her house in Ipswich, Queensland, she signed up for an interest-only period. The fact the repayments were going to be a bit lower was the major draw card, she told 730. But I didn't quite understand the implications. Now here, this second quote is the most important part of this entire piece, I would argue. Now, you can just easily mock these people or say, oh, it's just greedy investors. But you've got to realize a lot of it also is just showing you how bad financial literacy is in this country, how bad the education system lets us down. I mean, what were we taught at school? Those of us that went to the public system, what were we taught about finance at all? I remember in high school they had us do a survey. I think I was the only one that said, why aren't we being taught anything about finances? And now I realize the teachers probably have no idea about it, but still. The reason repayments were originally lower is that during an interest-only period, borrowers are not paying off the debt they owe to the lender. When the term ends, or resets, as it is called in the industry, a borrower will start paying off both principal and interest unless they can secure an additional interest-only period. And for those who cannot negotiate another interest-only loan, it has the potential to increase their repayments by thousands of dollars a year. I mean, it's also another idea. I always envisaged this as a tool used for investors who were happy to make a loss or maybe wanted to flip a property. I never envisaged it as a tool that you would use for something you would live in. So, $500 billion of loans to reset. Here is the issue, guys. Here is the issue. During the most recent property boom, mortgages on interest-only terms became extraordinarily popular in Australia, at their peak accounting for nearly 40% of the market. I mean, the banks would love that. Just keep you locked in. Essentially, it's just, for them, it's a whole period where you're simply just paying money. You're paying rent. You're essentially paying rent to the bank. They own the property. You're not paying down any of the capital. You're paying rent to the bank. The financial regulators realized there was a risk some borrowers signing up to interest-only periods might struggle when they had to start paying back the principal. According to the Reserve Bank of Australia, the move from an interest-only period to principal and interest repayments costs borrowers on average an extra 30 to 40%. Wow. If people are unable to afford the jump, they could be forced into default or into selling a property. But just think about that, 40% of the market, guys. 40% of the market. And I will just bring up a little chart here to show everyone the extent of foreign investment in our property market. Heating up the sector, pushing up prices. Wonder how many of those were interest only. So a lot of people are a lot of people doing that at the same time could lead to falls in the property market. Yes, large falls, as they're saying. So the regulator forced the banks to massively curb how many interest-only terms they were offering. But the RBA also warned last year that given the huge number of interest-only loans already agreed to, there were nearly $500 billion of loans resetting over 4 years. And with the new tightening rules on interest-only terms, a lot of these borrowers would not be able to extend the interest-only period. $500 billion, guys. Just think about that. $500 billion. So, in Miss Christopher's case, the interest-only period came to an end in 2016, and her bank did not want to extend the term. Now paying off the principal as well, she saw her repayments jump by nearly $5,000 a year. It causes me a great deal of stress and anxiety, she said. I do manage to keep it to myself fairly well, but there's still always the fear that if something big was to happen, I don't know where I'm going to get the money from to try and keep things going. For people who are faced with a steep increase in repayments they cannot afford, one option is to attempt to offload the property to pay down the debt. But Miss Christopher could not get the price she wanted, so she tried to sell the property in Ipswich, of all markets, which it's not really a hot suburb out there. It's a city to the west of Brisbane, and I don't think the economy is thriving out there. I've worked on a few projects. So when I tried to sell the house, the way the agent had marketed it was that it was an investor liquidating an asset, which brought out all the tire kickers who came in with ridiculous lowball offers, she said. Their offers were even less than what I'd bought the house for 7 years ago. Okay, so she's learning that things can lose value. She's learning that things can lose value. I think a lot of people are having to learn that. I mean, $500 billion, guys, coming back onto the market. And interest rates are at insane low levels. Mr. Christopher is holding on, but she is struggling with the repayments, even after 3 interest rate cuts by the Reserve Bank this year. And here we go. Here's a boomer couple. Payments would have gone from $2,000 to $7,000. So retired police officers Peter and Bronwyn Dwight built up a large property portfolio to fund their retirement. After I got interested in property investing, I read so many books on the matter, and I decided to make a goal of 30 properties, Mr. Dwight told 730. Yeah, but you didn't own any of them. You didn't own any of them after all. It doesn't look like it. 30 mortgages. That's 30 debt traps. Wow. I mean, this just seems ludicrous, guys. This is showing you how much of a bubble we've had in Australia. When, coppers are aiming to get 30 properties. I think we got up to 16 income-producing properties, and that meant we didn't quite reach our goal. But hey, we set a goal for Mars and we landed on the moon. Most of their properties are currently in interest-only periods. We went with interest-only mortgages because they provide a cash flow. You're not paying off the loan as such, Mr. Dwight said. So the bank holds the property. Wow. They took out a 30-year loan with the Commonwealth Bank on one of their properties. For the first 15 years, they paid only interest on the loan, with 3 separate 5-year interest-only periods. When the most recent interest-only period reset, this year, though, the bank would not give them another interest-only period. So they face having to repay the principal in just 15 years. If it was going to revert to the principal and interest on the current interest rate that they had, the payments would have gone from about $2,000 a month to close to $7,000 a month, Ms. Dwight said, which just wouldn't have been financially viable for us to maintain. It would also force us into having to consider selling a property before we were ready to do so. Oh no. Oh no. Yes, well, the bank can do what the bank can do, can't it? After over 14 or 15 applications to different banks, the Dwights were able to finally secure another interest-only term. Oh, aren't they lucky? Aren't they lucky? You think they would learn from this? What if the prices crash as certain people are predicting? What's that going to do? Wow. So prepare or struggle. But the Dwights are not out of the woods yet. They have many other interest-only loans due to convert to principal and interest over the next few years. We've got 5 lenders and 8 loans, Mr. Dwight said. So in the next year, for instance, there's 2 more to go. And then over the next 3 to 4 years, they'll begin to come out progressively. Ms. Dwight warned others not to get caught unaware. I would suggest that there are a lot of people who are facing the same difficulties that Peter and I have just been facing and continue to face, she said. If they're not thinking about it, and they're not preparing themselves, and they're not working through it, they're going to find themselves really struggling. Despite their difficulties this year, Mr. Dwight remained confident that property was the right option for their nest egg. I think the demand for housing is still very, very strong, he said. But he is still keeping a close eye on how the interest-only transition plays out. Okay, why does he think demand for housing is very, very strong? Is it going to continue? Does he realize how much of this demand has come from foreign investment and how much it's crashed down? That black line on the chart I'm showing you guys, that is the amount of building approvals for residential building approvals from foreign sources. It's over 90% at one stage. Don't people see this? Okay, sure. He's got 30 more, or 16 mortgages. He knows what he's talking about. With people coming out of interest-only loans all in one hit, I don't know what will happen, he said. I suppose that we'll just ride through when it happens. So don't ignore the risks. So far, the concerns about the glut of interest-only terms ending at the same time have not caused a surge of loan defaults or investor fire sales selling their property, according to economist Saul Eslake. Interest rate cuts appear to have helped turn around the market, and banks are once again loosening their lending standards, with the threat of the Royal Commission now behind them. But Mr. Eslake warns that people should not ignore the risks. He's right. You know, it could be that the people for whom the transition is going to be the most difficult is the cohort that is yet to make the transition, whereas those that could do it comfortably did it sooner rather than later, he told 730. Indeed, some of the Reserve Bank work suggests that a number of people have transitioned ahead of the legal requirements to do so. So we'll have to wait and see how difficult it is for the remainder. So guys, what do you think about this? Do you think it is going to result in a fire sale? Do you think it is going to have, affect the market? Or are most people going to be able to deal with it? Is it going to be a small amount? What about the new 10,000 10,000 government guaranteed house deposits? Do you think that will affect this? It's interesting to watch. It just seems insane that 40% of the market, nearly 40% of the market, was this type of product. Can't blame the banks for doing it. You know why they want to. But some people need to really get a better financial understanding of what they're doing. There's no point, doing interest only, and then taking the money, maybe investing the saving into something else that you might get a higher capital growth than paying off your home. That might be smart. What if you do 5 years of that and put it all into silver or gold? particularly if she started back then. That would have been smarter. Particularly out at Ipswich, I can't imagine the property's gone up that much there. But somehow I don't think that's what happened with this example. Anyway, guys, what do you think? Let me know in the comments. Are you worried about this? You think the bank should be allowed to do it? Or maybe, here's a suggestion. Maybe there should be a period of capital and interest only that you have to pay prior to being able to go interest only. So you can't automatically go straight away interest only. You need to prove your capacity to actually manage it, and then maybe a year or 6 months, then you can flip. Why not? So wait a minute, give people the advantage of, or the benefit of going interest only, but also ensure that people aren't rushing in without understanding the real implications. Anyway, guys, leave your suggestions in the comments. Like, share, and subscribe. If you like the content I'm producing and want to help, I have a Patreon and Subscribe star. Every contribution is greatly appreciated. I also have referral links for Amazon and eBay, and it doesn't cost you anything and really helps the channel. Take care, guys. Have a good day. And I'm going to go back to my bookkeeping. Wish me luck.